Hi everyone, sorry about that. I thought I'd lost the chart. I found it again. Do that all the time, click the wrong button. I'm going to stay with Disney and this particular chart, which is the 10-minute. I've got a whole series of timeframes there, as you saw. But what I wanted to focus on this chart, really just a couple of lessons that are really underpin what VPA is all about. And the first of those is trap moves, because if you study volume price analysis, then it really does truly reveal what we always say, which is the truth behind the price action. Is the price action valid? Is volume and price in agreement? If it is, happy days. If it isn't, we need to do some analysis and understand what is going on. And what I just wanted to show you here is really a classic example, because what you tend to look at in any price chart is your eye will be drawn to those big candles on the chart, which have potential to be anomalous, in the same way that your eye is drawn to very large spikes in volume, and also the opposite, very low volume. So it's just a fact of life. That's what your eye is drawn to automatically. We've been doing this so long. That's what we look for all the time. You're looking for those things which just grab your attention straight away. And what grabbed my attention with this chart was this candle here. We've had the open, we've had the gapped up open, and on up we go. And as usual, there's a lot of volatility open. And then we get this big widespread candle. Now, it doesn't take a genius to work out that if you're going to see that much amount of effort, then what we should expect to see is something that stands out down here in terms of the volume. And it doesn't. All we've got is just what we could say is an average kind of volume bar for this early in the session. So immediately it tells you that this is potentially a trap move. It's anomalous. Why is it anomalous? Because by any standards, and we do a lot of benchmarking in volume price analysis, we are constantly looking at, within a session, we're looking at the spread of a candle and the associated volume, and measuring that against other similar candles of similar size and shape, and see what their volume is. And if the two are in agreement, we can say, yeah, okay, that's fine. We're in agreement with our benchmark candle or our benchmark volume. But if the two of them are not in agreement, then clearly there's something anomalous. And the trap moves are something that occur in all time frames, in all markets. You see them endlessly in the Forex world. You see them here as well in stocks, because the market makers are there to make money. They are there to trap you on the wrong side of the price. They are there to move markets around rapidly, because what happens when you get a big move like this is that you will have seen the gapped up open, and you will instantly assume from this widespread candle, if you're not already getting in as it's building, certainly up near the top here somewhere, this market is going to take off, so I'm going to buy. It's the classic fear of missing out, FOMO, which the market makers understand all too well, and we all suffer it because we are here to make money, and often we are sitting here as we are at the moment. The markets are kind of moving sideways because of the holiday period coming up. So we're sort of sitting on our hands as an intraday trader and really just looking at the charts and trying to find something to trade, and probably not finding very much at the moment because nothing's really moving fast. As soon as something does move quickly, and we're looking at that particular chart, our emotion response is to jump in. Let's buy. This is going to be some quick cash. I've been sitting here for an hour or so. I want to make some money. Let's jump in. And that's really the basis of it. It's a very, very simple emotional trigger. The market makers use it all the time, every single day of the 365 days or the 300 days of trading. And really, the only way that you can unpick it is to look at the volume. Does this volume, from a very simplistic view, I mean, even if you knew nothing about volume price analysis, does the volume down here look in agreement or in disagreement? It's actually this red candle here is this one. This long-legged doja here, it's colored green. It may have closed marginally up. It's difficult to tell. And it's actually this volume here under this particular candle. So does that volume look in agreement? And the short answer is no, it looks out of balance, because for that sort of price action, even if you went on some of these over here in another session in a previous day, and you look at the volume there, you look at the volume with these candles up here, you should see an awful lot more, and you don't. So instantly it gives you a warning. It doesn't automatically mean that you just jump straight in and go short, but it's giving you a heads up that this is a trap move. The probability is that we're not going to go very far, because the market makers have moved it up very quickly, and therefore the likelihood is that we're going to go sideways. Now, I haven't got the volatility indicator on here, but if I did, chances are this would have triggered on the volatility indicator. And for those of you who know that particular indicator well, we'll also know that generally what happens is that in two things will follow on a volatility trigger. Either we will see congestion, or we will see a reversal, and we got both on this occasion. We got the congestion followed by the reversal. So that's really the first point I wanted to make about this chart. The second point was also really to do with levels. I've got the accumulation distribution indicator on here. These little levels here, perhaps you can't see them. This is 3, this is 3. These little numerals on here. The thickness of the line denotes the strength of the resistance that is building at that particular level. But even if you didn't have the indicator on, you're still looking at a level over here. This was an important level a couple of days ago. The market got to this price action and then rolled over. So purely from a very basic inspection of the chart, just on one time frame, you'd be looking at this as a potential weakness, certainly coupled with this trap up here. Then you start to look at the candles that follow on. We've got weakness here. We've got big wick to the upper body. That alone is telling you. The doji candle, just reminding you, doji candles are not about reversals. They are about indecision. When you get a doji candle like that, it's about indecision. It doesn't mean the market is going to reverse necessarily. It just tells you that we're going into an indecisive phase. The bulls and the bears are in equilibrium there, and the market is really not going anywhere. Then we get weakness here. We get further weakness signaled here. And if you look at this effort to rally here, the volume here is really very, very minor in this four bar up rally here. Really doesn't look particularly strong. There's no great up thrust there in terms of the spread. The spreads are narrowing as well. And this is another aspect of volume price analysis, is not only are we looking at the relationship between individual candles and the volume, we're also looking at the relationship between whether a market is rising on falling volume, or falling on rising volume, or falling on falling volume, whatever it may be. And in addition to that, you're also looking at how the spreads of the candle themselves, just purely from a price perspective. You don't necessarily have to know anything about volume. If you just looked at the spreads of those candles, they are narrowing. And that narrowing is also telling you quite clearly that this is a relatively weak market. So when you put all that together, the basis of any trading decision would have a bias to the downside. It wouldn't have a bias to the upside. I'm not saying you jump straight in there and it's an obvious shorting opportunity. All I'm saying is that in your mind, these last 10 or 12 candles together associated with the volume patterns have really just reinforced the fact that this is a potentially weak market. And therefore, if you are going to do anything, the probability is that it will be something to the short side rather than something to the long side, all things being equal, assuming there's not, I don't know, some earnings release or somebody says something about the stock or whatever. So all things being equal, you would look at that and say, well, if I was a gambling man, I'd put, heavier odds on a short than a long. That's what I'm saying. And that's really how you build the picture up. Then you've got the indicators which help. So say this might be a volatility trigger. I haven't got the volatility indicator on this particular chart. I've literally just got the histogram behind there is the volume point of control. And that's all I've got here with the volume. Because as I explained in the webinar this morning on Forex, what we're looking at with the VPOC is we look at VPOC, this histogram here, this volume histogram here. We use it in exactly the same way as we do with price. The accumulation distribution is based on price. We're all familiar with price resistance, price support. but you use the volume histogram here in exactly the same way. We're currently trading in a very dense area here. So when this market comes down, when this stock comes down and starts to approach this region, it's no great surprise it's going to pause here. Why? Because we've got a ton of volume sitting there. And in that volume, there are all sorts of people sitting there with orders, pending orders, people who got in and now want to get out because the market's reversed. So they've got in here, maybe got in halfway up here, market's reversed, now they're back down here and they're sitting there, and all these orders are going to be transacted. So you've got tons of volume sitting in here. The important point is that if the market does break to the downside, and maybe it will, we'll see, but as I say, we're coming to the end of this session and into a holiday period. But if it was a regular session, what we'd be looking at for a further short or a further shorting opportunity is a move down into this region, because if it moves down into this region, the chances are it's heading down back to the VPOC at 94.45. And this low volume area here would be very, very welcome, because as the price breaks through here, there is very little here in the way of support. So the price is going to move through there pretty rapidly. Not a great deal of headroom down to here, but the principle is that when price approaches these low volume areas, it's happy days if we've got a trade running or in a position, because the chances are the price will move through there fairly rapidly. So I wanted to spend some time on that, just on that particular chart, because there's lots of lessons there. If we go down onto the 5 minute, just have a quick look there. And this is another aspect of why we use multiple time frames, and really to pick up on what I literally just said about low volume nodes. Here you can see on the 5 minute time frame, we had a low volume node. So as this price breaks lower, we get down to this region here. What do we expect to happen? Well, we anticipate that it will move through there fairly quickly, which it does. We get a straight candle straight the way through. And that's what you expect to see. So again, it's bringing in not only the elements of VPA 101, but then combining that with all the indicators as well. And in addition to that, if we're on the 10 minute, we might be wondering, well, why are we moving into congestion? Because we're not at the VPOC. That's true on the 10 minute, but on the 5 minute, we are. We're at the volume point of control. We've got our heaviest concentration of volume, which is here, as denoted with the purple dashed line, which denotes our VPOC. So we're in sideways. So if we're jumping into this trade somewhere down here, maybe we had a floor here and we're looking at that as a trigger, and we got through the floor and they're great, okay, we think we're going to go short, so we start to short it. The question you have to ask yourself at that point is, am I happy taking a short which is likely only to deliver this much? Just move that out of the way, which is not a great deal. I mean, it's roughly 30 cents, let's say. Is that enough for me? Well, it may be. For other people, it may not be. But you're making a conscious decision before you enter the trade, knowing full well that the probability is that if we break through here, there's not a lot of headroom to make a trade, to profit from it, because you've got the VPOC down here, which is very close. If you're happy with that, fine. If you're not, you don't take it. It's as simple as that. So it's putting all those pieces of the jigsaw puzzle together. And this could be any stock, it could be an index, it could be commodity. It doesn't make any difference. It all works in exactly the same way. Moving down onto the 3 minute, let's see what's going on in the 3 minute. Anything different here? Well, we've got the VPOC is slightly higher, so it's up here. What we're seeing on the 3 minute, which is very nice, these two dotted lines, this blue one and this red one, these are from the accumulation distribution indicator. And they are telling us that we have a very, very solid area of what is acting as price resistance at the moment to this stock moving above it. You can see here how it's been tested. It's almost pinpoint accurate. It's been tested again here. It's trying to rally through there. The good news is, from a long perspective, if it does manage to break through there and we get some decent volume down here, although the volume is pretty weak, but if we did get some decent volume, and you would have to see volume for this to be penetrated, then of course that resistance then becomes support. And if we look at it from a perspective from a long position, that we would then have support in place underneath. We've got a nice low volume node here at 95.30. So the potential for this opportunity, if we're looking at taking a long position now, is from 95.20, let's say, up to 95.50. So we've got 30 cents that way. Before we know full well that the price will run into resistance again up here. Why? Because we're reapproaching the VPOC on this particular time frame. Now remember that in looking at multiple time frames, the slower the time frame, the greater will be the significance. So the significance of the VPOC on the 3-minute time frame here will not be as significant as that on the 5-minute, and the 5-minute will be less significant than the 10 and the 15 and so on and so forth. So if you're seeing things on an hourly time frame and you're trading something where maybe the price is approaching something significant on an hourly time frame, that is going to carry significantly more weight than something that's happening on a 15-minute time frame. So you've always got to bear that in mind. And the issue, as always, from an intraday perspective, is how you set out your stall in terms of your time frame reference. How far are you going to go out? Because we've all done it. You can put a trade on and then it doesn't quite work out, so you go and have a look at slower time frames. We've all been there. It really is, the analogy I use is blinkers on a racehorse. You put blinkers on a racehorse because they lose focus when they've got other horses around them. And it's a similar thing here. You have to kind of put blinkers on and say, okay, well, I'm only trading this on a 5, 10, 15, 20-minute time frame or whatever it is, and not really worry too much about what's going on the hourly or the 4-hour, whatever it may be. And if it doesn't work out, it doesn't work out, and you get out, and that's it. You're on to the next one. It's very hard to do. It's very easy to sit here and say it. It's harder to do in practice, but that's what you have to try and force yourself to do, to really focus in on that timeline that you're really focusing on. I'm an intraday scalping trader. That's what I'm doing. I'm on the 1, 2, 3 or the 1, 3, 5, whatever it is. And then the rest of it, okay, I've got slower time frames just giving me a heads up on what may be happening in terms of resistance, support, VPOC, whatever it may be, and volume profiles as well. You can see here as I'm talking, it's literally bounced off that level again. And every time it hits that level and is repelled, then what happens with the accumulation distribution indicator is that the level increases in strength. It's like Popeye and his spinach. He eats more spinach, his muscles get bigger. Well, it's exactly the same here. Every time that level is tested and holds firm, then it gains strength. So it thickens. And the beauty of the indicator is it's very visual. You don't really need to know what the numbers are over here, although they are tiny. They are there. So it's really a visual indicator for doing this automatically, for delivering all these levels up and down the chart. And you can have just the majors, or you can have all of them on. Plenty of controls within the indicator itself to set them to whatever you prefer. I'm going to pass back to Anna at that point, if I may.
Hopefully you can see my screen now. This is the weekly chart for Disney, and we've gone completely to the other end of the time frame spectrum, and there is a reason for this. Just also bear in mind that when you're looking at perhaps trying to get a feel for the bias of what a stock might be doing on the day, on the faster time frames, you certainly should always consult the daily and sometimes even certainly the weekly chart at the beginning of the week, because that can often tell you, will give you a hint as what could possibly be happening the week ahead, as it were. But this is the reason I wanted to look at Disney, as I said, from a VPA perspective on the slower time frames. First of all, with Disney, obviously Disney is such an iconic name and an iconic brand. You all know the history of the company. Actually, let's just go to the monthly just to get a flavor of where it is at the moment. And we can see the extent to which it has fallen. If we go right back to, I don't know how right, 1999, we were down in the $20, $30 and what have you. But it really had a boost once the shortest recession in history was in 2020. We all know what happened in 2020. We had the big collapse in the markets because of the pandemic, and then it shot back up again. It went from $80 up to a high of, let me just have a look, it's about $200. Let me have a look on my trading view. It got a high of $203. Now, when you get a company with such an iconic brand, an iconic name, and it has had a high of, as we have here, the 203, and it's back to $80 or so, it's fallen all the way down, you do get this you get a viewpoint from, I'm talking about investors here, that, oh my goodness, it's such a well-established brand, it's etc. The price has fallen so much, it now must therefore be cheap. And you will get investors thinking, great, maybe it's time to get back in. But the $80 level is actually really, really important, which is why I drew this line on it. It's also coincided with the these lines here, not the accumulation and distribution, these single lines. These are derived from the volume point of control. The volume point of control, if you like, frames. It gives us a range. It can be a very wide range. So this is the lowermost band, but when it coincides with a significant previous level from where the stock bounced higher. So we can see that there's going to be an awful lot of thought going into, my goodness, it's back to this level here. It went up from 80. It's already fallen down from 200. So possibly it is a good time to move back into Disney at this point. When we look at the weekly chart and also the daily chart, investors have had that belief or had that approach to this stock every time there's been an earnings announcement, whether the earnings was good, bad, or indifferent. You will see a lot of volume going in around earnings, but in fact, over the last year or so, it's just precipitated the slide lower. But it's, as I said, it's at an interesting point for all sorts of reasons. If we look at the volume also underneath the candles, it does give you some kind of encouragement, because there's a lot of volume under that tiny little down candle. Well, if that was all selling, you would expect the candle to be much wider and much lower, and certainly below $80. So the $80 is, as I said, it's like Nvidia. When we look at it later from a different perspective, it's kind of could be a potential inflection point. But it's the weekly chart that I want to highlight, because here we have, this encapsulates the top that we saw on the monthly chart, and I've simply just highlighted it because it's a sort of, if you like, a kind of distributions, a lot of very candles with lots and lots of wicks, but the price really isn't going anywhere, and it really starts to break down, if you like, once you get this very widespread volatility candle with a lot of volume underneath it. So I wouldn't say it was quite in free fall, but it certainly was enough to push the stock price from, as I said, the high of 200, over 200, and you're now down to, what is it, 158. To lose $50 is, in a relatively short space of time, it's harsh. Whatever the company may be saying, there could be all sorts of reasons for it. I don't know whether it was their output. I don't know whether it's losing competitiveness. If we think about it, Disney, until all the other streaming platforms came on board, and the other Pixar and what have you, it really didn't have any competition. And it's an example of a company that until it kind of lost its competitive edge. And those of you who follow Warren Buffett, or who know his letters and his works, will know he uses this expression of a company having a moat. And what that actually means is it has a competitive edge. And once a company loses that competitive edge for whatever reason, maybe technology changes, maybe there are more competitors coming into the market, then that moat gets smaller and smaller. So, as I said, there could be all sorts of reasons. But the thing to watch is when a company, such, not just Disney, but any company, starts to go into this, I wouldn't say free fall, but starts to fall, you will then get this thing of, well, you know, it's fallen 10, 20%, maybe now that it's time to buy it again. And this is where VPA really, really steps in, because what I want to point out here is, when you get, what do you see on the rallies? David has shown you what happens on the faster time frames, and it's exactly the same lessons on the slower ones. We have a lot of volume going into that. Could be looks like a little hammer candle. It's got a wick to the bottom of the candle. If I just expand it a little bit there, yeah, there's a classic VPA. It's had this big fall, come down to a support level. Nice volume underneath it there. Yeah, you know, is it potentially a time to buy? Lots of people would have been stepping in, and then you get a rally. And this is what we were saying about the anomalies. You either get rising prices and narrowing spreads on rising volume, which is an anomaly, because if that was all buying, that candle should be much deeper, much wider, and it isn't. Or you get a rally with rising prices and falling volume. So that is what you should train your eye to look at when you get the beginning of the trend, or whether it is in a trend. And it stops. It reaches this little resistance, and it goes down again, and we get 2 down candles, and then we get another attempt at a rally here. What do we see this time? We see another sort of little hammer candle, and the price goes up again. What happens is you have a lot of volume under that candle there, but it's got a deep wick to the top of the candle. That's also a deep upper wick to the candle, and down it goes. And you then start to look, well, actually, you've got lower highs. You're getting, well, certainly there, you've got a lower low. These are the kind of areas that you need to start to spot and recognize when a stock or an index is on the move. You want to try and see these anomalies to see whether these pullbacks, it's just a pullback, or is it the start of a major reversal. And we go on, and they just carry on, and in fact then we end up with this waterfall. But what has happened since May 2022, we then go into this long extended period of sideways, and it's a case of, well, it's 123 to the upside, and as I said, at the time it was 90 to the downside. We have the volume point of control. What is happening? We keep getting these attempts to rally. There's an awful lot of volume under that candle. Yes, it looks, you know, a nice wide candle, but really not consistent with the volume that's underneath it. And in fact, it coincides with an earnings, whereas, as I said, a lot of volume going into the stock following earnings, but there really isn't any follow through. And it's really been bouncing around since, where are we here? August 2022, and kind of sliding lower down to the this 78, 80 level that corresponds with the rally back in 2020. Now, what's interesting is, while it was moving sideways, a couple of things. I highlighted this in our Forex webinar this morning. This little indicator we have here, this is our pivots indicator. And what the pivot indicator is actually very good at, it's triggered on a 3-bar reversal. And it's very, very good at in congestion. When you start getting pivots, as you do here, you know you are going to be in sideways. Whether that is going to be an accumulation, whether that's going to be a distribution, we don't know. We simply have to be patient. And it's a very similar situation that we have over on NVIDIA. But what it does, particularly here to the downside, we have this very, very strong level of what it has been support, but now it's had a break lower, and it's gone down to, as I said, the level that corresponds over to the 80 from 2020. What Disney then now has to do, and we can see volume going in, we can see the volume going in, as I said, there's a lot of volume going in around earnings, but it really hasn't done an awful lot for the stock so far. It's a kind of grind higher, and it's going to have to put in an awful lot of effort to actually get back. First of all, it's got to stay above 91, which is this, which was support. Then it became a ceiling of resistance. It has managed to get through. Now it's at the volume point of control, but it's got a long way to go and a really grind higher, because it's got to get through all this volume resistance as well that is around the volume point of control. So the takeaway lessons from this these, first of all, the the VPA anomalies that you see on a faster time frame are identical to those that you see on a slower time frame. Really depends on your own time horizon. You will see the same signals, you will see the same patterns, you will see the same combination of candles, and from your perspective, what your eye has to be drawn to all the time is start with those anomalies, because once you begin to see the anomalies, everything will then drop into place. Do you agree with that approach, David? Learn to spot the anomalies first. Say, well, why was that? So looking at a chart historically is a great way. You look at it and you're saying, well, why did it stop there? What was it in the price action and the volume that prevented that move either going further higher or lower? You can also incorporate all the other things that we technical analysis lessons, if you like, and that is, in a trend, you higher high and higher lows, or lower highs and lower lows. Do you want to do trend lines? Fine, do your trend lines. Put your Fibonacci on that. I've been looking at Fibonacci on the SPY, and it's absolutely fantastic. We use Camarilla. Fine, great. But they all come second once you look at the price action and the volume and see where, if you can spot those anomalies. Is there anything you want to add to that? Is there anything else that you can see? Because we've decided with David, we'll say I'll pick up some things and he can pick up other things, and you may pick up other things as well, because you may use, I don't know, let me think, maybe you're an Elliott wave trader. I don't know, maybe you use other indicators. Are they telling you something? What price and volume do, they help to validate those indicators that you use. It's not the indicators first, it's the price and volume, and the indicators support that, and the price and volume then say, yeah, I can see the divergence there, and that divergence is genuine because it's the volume that is confirming that. Right, that's what I want to say on that. Is there anything you want to add to Disney? Can I